Thank you very much, Lord Mayor. It's a great honor for me to be here. Thank you for reminding me about the perils of our task at the Bank of England. You left out in your opening comments, although I know you know this, that when the bank was first founded in 1694, we were founded to promote the public good. The public good defined then was to raise money for the war against France. So some things never changed. Did pay us back, though. And I have to say we're very confident that the government's current indemnity of our asset purchase facility will hold true, all 375 billion of gilts that we hold in the Crown's name. Thank you again. Thank you, Lynn, for this extraordinary conference. My lords, ladies, and gentlemen, it is a great honor for me to speak this evening. It's going to be a little more difficult to be interviewed by Zanny afterwards, but President Clinton, in a true tour de force, began at the end. And he began at the end, and I'm paraphrasing, by talking about the success of cooperative societies. The success of cooperative societies, and particularly cooperative societies that focus on doing something. I'm going to begin at the beginning, and of course as a central banker I'm going to try not to say anything, let alone do anything. But I'm going to begin at the beginning because what I would like to do at the very start is try to define what we've been talking about, what is inclusive capitalism, because it can mean different things to different people. And at least to us, it's fundamentally about delivering a social contract that's comprised of three things: relative equality of outcomes, absolute equality of opportunity, and fairness across generations. And societies, different societies put different weights on those three factors, but all societies, I would suggest, aspire to this trinity of distributive justice, social equity, and intergenerational equity. And they do so for at least three reasons. And the first was mentioned by Christine Lagarde this morning and backed up by quite some extensive research by the IMF, which echoes research by others, that shows growing evidence that relative equality is good for growth. I would suggest as well that at a minimum few would disagree that a society that provides opportunity for all of its citizens is more likely to thrive than one which favors an elite, however that elite is defined. The second reason why societies favor or put weight on these three factors is that research suggests that inequality itself is one of the most important determinants of relative happiness and that a sense of community, which itself is a form of inclusion, is a critical determinant of well-being. And the third, maybe the most fundamental reason why societies favor this trinity is that they appeal to a fundamental sense of justice. And who, behind the proverbial Rawlsian veil of ignorance, not knowing their future talents and circumstances, wouldn't want to maximize the outcomes of the least well-off. And so gatherings like this, which is exceptional, but similar gatherings have been held in recent years, they've been prompted by a sense, a concern that this basic social contract is beginning to break down. And that unease is backed up by some hard data. At a global level, as we heard several times today, the news is quite extraordinary, quite positive. There's been a convergence of opportunities and outcomes at a global level. And that's because of the convergence and the narrowing of the gap between emerging and advanced economies. But within societies, virtually without exceptions, there's a few exceptions, Mexico, Brazil, mentioned in the last decade, inequalities of outcomes both within and, very importantly, across generations have demonstrably increased. The big drivers of globalization and technology are magnifying market distributions, and returns in a globalized world are amplifying the rewards of the superstar, and though few of them would be willing to admit it, the lucky. Now is the time to be famous or fortunate. Importantly, there's disturbing evidence that equality of opportunity has fallen, with a potential to reinforce existing cultural and economic divides. And intergenerational equity is similarly strained across the advanced world. Social welfare systems designed and enjoyed by previous generations may prove, absent reform, unaffordable for future ones. And as His Royal Highness stressed this morning, environmental degradation remains largely unaddressed, a tragic embarrassment seldom mentioned in polite society or at the G20. In order to maintain an inclusive social contract, it's necessary to join economic and political philosophers such as those quoted by Larry Summers and others earlier this afternoon, ranging from Adam Smith to Hayek, who have long recognized that beliefs are part of an inherited social capital, and that inherited social capital is essential for the social framework for the free market. So the question is, what are those values and beliefs that are necessary for modern inclusive capitalism? Well, first, to be absolutely clear, to succeed in a global economy, dynamism is absolutely essential. To align incentives across generations, a long-term perspective is required. For markets to sustain their legitimacy, they need not only to be effective, but also to be fair. And nowhere is that more acute than in financial markets. Finance, as many of you emphasized, has to be trusted. To value others requires engaged citizens. In short, there needs to be a sense of society. Now, importantly, those set of beliefs and values aren't necessarily fixed. They need to be nurtured. And my core point is, and you spoke, Madam Lord Mayor, about revolution, just like any revolution eats its children, unchecked market fundamentalism can devour the social capital that is necessary, that is essential for long-term dynamism of capitalism itself. And in order to counteract this tendency, individuals and their firms must have a sense of their responsibilities to the broader system. And this is because all ideologies are prone to extremes. Capitalism is no different. It loses its sense of moderation when the belief in the power of the market enters the realm of faith. In the decade prior to the crisis, such radicalism came to dominate economic ideas and became even a pattern of social behavior. As Michael Sandel outlined, we moved from a market economy towards a market society. Market fundamentalism in the form of light-touch regulation, the belief that asset bubbles cannot be identified in advance, and that markets always clear, contributed directly to the financial crisis and the associated erosion of social capital. And ensuing events further strained trust in the financial system. In particular, many supposedly rugged markets were revealed to be cosseted. Major banks were too big to fail, operating in a privileged heads-I-win, tails-you-lose bubble. There were widespread rigging of benchmarks for personal financial gain. And as Roger Martin and others have detailed, equity markets demonstrated a perverse sense of fairness, blatantly favoring the technologically empowered over the retail investor. Such practices widen the gap between insider and outsider returns, and therefore challenge distributive justice. And more fundamentally, the ensuing mistrust in market mechanisms produces both happiness and social capital, and ultimately undermines the dynamism of capitalism itself. And so my point is, we can't simply take, in fact none of you would be here if you did, we can't simply take the capitalist system, which has produced so much, such plenty, and so many solutions for so many, we can't take that system for granted. It's necessary to rebuild social capital in order to make markets work. And this isn't an abstract issue. It's not a naive aspiration. I'll argue, as the Lord Mayor alluded in her opening remarks, that we've already made a start with financial reform, and that by completing the job, by returning to true markets, we can make capitalism itself more inclusive. But in doing so, we need to recognize that there's a tension between pure free market capitalism, which reinforces the primacy of the individual at the expense of the system, and social capital, which requires from individuals a broader sense of the system. In other words, a sense of self must be accompanied by a sense of the systemic. So I'm going to outline relatively briefly, relative being the key word there, 4 financial reforms that are helping to create this sense of the systemic and thereby rebuild trust in the system. And I'm going to start with ending too big to fail, as many of the speakers mentioned today, because that's the area where there was the most severe blow to public trust, this revelation that there were scores of financial institutions, not just 1 or 2, scores of financial institutions across the globe that operated at the heart of finance that were too big to fail. Bankers made big sums in the run-up to the crisis. They were often well compensated after the hit, and taxpayers picked up the tab for the failure. This directly contributed to inequality, but more importantly, had a corrosive effect on the broader social fabric of which finance is a part and on which it depends. So what we're doing now is we're replacing the implicit privilege of too big to fail with the full discipline of the market. The leaders of the G20 have endorsed measures to restore capitalism to the capitalists by ending too big to fail. The FSB has identified those institutions, both banks and insurers. We've made them subject already to higher standards of resilience. We've developed a range of tools so that they can be resolved without disruption to the financial system and without cost to the taxpayer. Now, Christine Lagarde rightly mentioned this morning that we've made much progress on this, but the job is not yet complete. This is the year to complete the job, and Brisbane in November, the Australian G20 summit, is the time to mark the scorecard. Now, the second set of reforms I want to highlight concern fair and effective markets. As I mentioned at the outset, in recent years, a host of scandals in fixed income, currency, and commodity markets have been exposed. And it's not enough just to prosecute the guilty to the full extent of the law, although that will be done. Authorities and market participants, and it's both, authorities and market participants, must also act to recreate fair and effective markets. In the Bank of England's view, this will require changes to both the hard and soft infrastructure of markets. Examples of the former include reforming the calculations of benchmarks such as to LIBOR or to FX fixes. Consideration can also be given to increasing pre- and post-trade transparency in a host of fixed income markets, and as well as accelerating the G20's pledge to move trading of all standardized derivative contracts onto electronic exchanges or trading platforms. Now, those are vital changes, vital reforms, and they need to be done, but they can't anticipate every contingency or discipline every miscreant. The scandals that have occurred highlight a malaise that exists in corners of finance that must be remedied. Many banks in recent years have rightly developed codes of ethics or business principles. But the question is whether all their employees have absorbed their meaning. And a first step to restore trust in markets may be to rely on traders' intuitive understanding of what constitutes a true market. So consideration should be given to developing principles of fair markets, codes of conduct for specific markets, and even regulatory obligations within this framework. There should be clear consequences, including professional ostracism, for those failing to meet these standards. The basic point is that all market participants, large and small, should recognize that market integrity is essential to fair financial capitalism. And taking a series of measures now will reinforce the city's well-deserved reputation as the world's leading financial center with the most efficient and effective markets. The third set of reform relate to compensation. Now, Dominic Barton and Mark Wiseman, who are here, have detailed the need for long-term thinking by concentrating on shareholder incentives. And a related lesson of the crisis was that compensation schemes that delivered large bonuses, see, I can't even say it, delivered large bonuses for short-term returns, encouraged individuals to take on too much short-term, or long-term and tail risk. To better align incentives with the long-term interests of the firm and more broadly of society, major changes are underway based on the FSB's principles for sound compensation practices. And here in the UK, the Bank of England has adopted a new code for banks prescribing deferred variable performance payments, introducing the ability to reduce deferred bonuses when subsequent performance reveals them not to have been fully deserved, and also to pay bonuses in stock rather than cash. We're in the process of continuing to refine our approach, but having said that, I want to make clear we understand fully that no compensation package can internalize the impact of individual actions on systemic risks, including on trust in the system. So to do so, market participants have to be true stakeholders. That is, they have to recognize that their actions do not merely affect their personal rewards, but also the legitimacy of the system in which they operate. And that leads me to my fourth and final reform imperative, which is namely to build a sense of vocation and responsibility in finance. To build a sense of the systemic, a sense of obligation to the system, business ultimately needs to be seen as a vocation, an activity with high ethical standards, which in turn conveys certain responsibilities. This process begins, as many of you know in this room, it begins by asking the right questions, some of which we heard and answered today. Who does finance serve? Itself, the real economy, society. And to whom is the financier responsible? Herself, his business, their system. The answers to these questions start from recognizing that financial capitalism is not an end to itself, but a means to promote investment, innovation, growth, and prosperity. Banking, as Sergio Ermonti emphasized this morning, banking is fundamentally about intermediation, connecting borrowers and savers in the real economy. But in the run-up to the crisis, as many of you know, banking became about banks, not businesses, transactions, not relations, counterparties, not clients. Financiers, like all of us, need to avoid compartmentalization. That is, the division of our lives into different realms, each with its own set of rules. A world where home is distinct from work, ethics from law, and the individual from the system. Reversing this process of compartmentalization, of finance being detached from the real economy, is well underway. It begins with boards and senior management who are clearly defining their purpose of their organizations. Employees must then, though, be grounded in strong connections to their clients and their communities. And to move fully to a world that once again values the future, bankers need to see themselves as custodians of their institutions, improving them before passing on to future generations. Now, here in the UK, there's two important initiatives that are working to help accomplish these ends. The first is a new regime for regulating the senior-most managers of banks. Its underlying principles are relevant not just to banking, but across the financial sector. People who run major firms agree that they should have clearly defined responsibilities and behave with integrity, honesty, and skill, regardless of whether they work for global investment banks, regional building societies, or British insurance companies. But ultimately, I just spoke about a regulatory initiative. Ultimately, social capital is not contractual, and integrity itself can't be bought and it can't be regulated. Even within the best possible framework of codes, principles, compensation schemes, market discipline, the individuals themselves must constantly challenge themselves to the standards which they must uphold. A meaningful change requires a true commitment from the industry, and that's why a second initiative, the recent creation of the Banking Standards Review Council, is particularly welcome. This is a new, independent body designed to create a sense of vocation in banking by promoting high standards of competence and behavior across the UK industry. And the BSRC is an important sign. In our view, it's a very important sign of the bankers' recognition of the need for change, and its impact over time will be a crucial test of the industry's commitment to that change. So let me conclude by drawing these strands together. By encouraging enterprise and rewarding individual initiative, market-based economies provide the essential conditions for economic progress. Of that, there's no doubt. But social capital must be maintained for that progress to be consistently delivered. The combination of unbridled faith in financial markets prior to the crisis and the recent demonstrations of corruption in some of these markets has eroded that social capital. When combined with the longer-term pressures of globalization and technology on the basic social contract, an unstable dynamic of declining trust in the financial system and the growing exclusivity of capitalism threatens. In order to counter this, rebuilding social capital is paramount. And my point is that financial reform is now helping to do this, to rebuild that social capital. Globally, systemic banks are simplifying and downsizing. Some are de-emphasizing high-profile but risky businesses that benefited employees more than their shareholders and certainly more than society. Authorities are working feverishly to end too big to fail. The structure of compensation is being reformed so that horizons are longer and so that rewards match risk. Regulation is hardwiring the responsibilities of senior management, and new codes are seeking to reestablish finance as a true profession with broader societal obligations. Finally, a welcome addition to these initiatives would be changes to the hard and soft infrastructure of financial markets to ensure that they are as dynamic and fair as possible. Through all of these measures, the financial industry can help deliver a more trustworthy, inclusive capitalism, one which embeds a sense of the systemic, a sense of responsibility for the system, and in which individual virtue and collective prosperity can thrive. Thank you very much, and I look forward, Ish, to the questions.
Failed dramatically. That was a pretty bracing analysis of the lack of inclusivity of financial capitalism. I was scribbling notes furiously. I'm just going to quote a few things back to you. Unchecked market fundamentalism can devour the social capital that's necessary for the dynamism of capitalism. You said that market fundamentalism contributed to the crisis and that ensuing events have further eroded trust in the system. It was, if one just heard that, to hear that from the Governor of the Bank of England in this location in front of this audience seems to me a fairly bracing analysis of the problems we're facing. You then went on to offer some solutions, and I want to push you on those a little bit more, because you gave a very big list of things to do. Which of your voluminous to-do list is the most important, and how much difference will it make? Will it make us feel better, or will it actually make capitalism more inclusive?
Well, let me say two things, Zanny. The first is, I like this sort of godlike voice. This is the voice I should have as governor, booming down from the ceiling. What I said about the analysis, that is the analysis that has motivated these financial reforms. There's a recognition that there was over-reliance in markets clearing all the time. There was over-reliance in completing markets as a response to any problem that developed, and that the collapse of those assumptions has led us to a series of changes. Now, which of those changes are the most important? I would start with too big to fail for several reasons, but the most important of which is that the presence of these institutions, for two reasons. First is, from a social capital perspective, there's a fundamental sense of unfairness that was revealed. And for that reason alone, it's necessary to make the adjustments. But secondly, the existence of institutions at the core of the system that amplified any shock because of the possibility of their failing in a disorderly way leaves us with a fundamentally unstable system. The consequence of that has been a series of measures in order to truly end too big to fail. That's why 6 years after Lehman Brothers, we're still talking about it. It's not that it's low on the priority list, it's that it's at the top of the priority list, and authorities are truly working to ensure as much as possible ex ante that that has happened.
Christine Lagarde this morning said, and you quoted one part of what she said, she also said that fatigue had set in. Do you think that you're really on course to ending too big to fail? And then I'm going to open the floor to questions. But if this is the most important, are you really succeeding at it?
Well, there are two crucial initiatives this year in order to substantially end too big to fail. There'll be cleanup issues afterwards. But the first is to introduce so-called gone concern loss absorbing capacity, which is another layer of bail-inable capital. It's another layer of capital into the institution that is required to stabilize the institution before the taxpayer is there. We're working flat out on this. There are 9 jurisdictions that are host to the 29 too-big-to-fail banks, and the intent is to have the principles in place, the structure in place by Brisbane. And we're on schedule, but I wouldn't downplay the difficulty of the technical issues there. The second one we could actually solve almost in this room, given I forget the trillion, 30 trillion of capital that's represented, which is to ensure that when a cross-border bank fails, that no particular group of creditors is unduly advantaged, particularly in derivative markets. And it's to introduce something called basically stays on those derivative contracts. We think we will have an agreement with the sell side, with all the major derivative banks, in the course of the next few months. That is very much because of the hard work and leadership of the sell side. We want to ensure that the buy side, the 30 trillion plus, is also supportive of that, because if the buy side takes seriously their sense of the systemic, their commitment to the system, they also need to participate in something like that, something like this, so that they're not taking advantage of everyone else who's working for the more inclusive solution.
So we will have made serious progress at solving too big to fail. Now, I have a ton of questions, but I'm quite sure that there are plenty of others. So if you let me put my glasses on so I can see you. Yes, why don't we start here, gentlemen?
Thank you, Mark. That was fantastic. The Governor, just prior to you, had a wonderful speech just before the collapse of a large UK institution, and it was about the balance between market discipline, self-discipline, and then regulatory discipline. Where is that balance now in what you've talked about?
Well, no, I mean, I think Mervyn's framework is right in that we're moving, even though we're putting in place a series of regulatory changes, what we're moving as much as possible is to more market discipline. It may not sound like it. It sounds like a lot of acronyms, a lot of people getting together in Basel and dreaming up new things. But in effect, what we're trying to do is push back market discipline. So the advantage of the too big to fail initiatives, whether it's bail-inable capital or other aspects, is that the private market holders of that debt will anticipate the risks that they are now running, risks that they're not putting back onto the state, and encourage changes to how those businesses are run, how much capital they hold, how much liquidity they hold. So the second element there is self-discipline, Mervyn's terminology, which is what the responsibilities of senior management, making them absolutely clear that if you are a senior management of a bank, you are responsible for what that bank does. It's quite incredible that that's not absolutely clear, either in corporate governance or regulatory terms. But in the aftermath of the 2008 crisis, at least in the UK, there's enough ambiguity about that we're making it absolutely clear who's responsible for the management. So I would put, even though there's a lot of regulation or regulatory initiatives, at the end, we're trying to put the discipline back to the market and the individuals who interact with the market.
Next question. Yes, over there, second table back.
My name is David Marsh. You're, in a way, on several sides of the trade as a central banker, Mr. Governor, because you talked about the buy side, but of course the central banks are very large owners of assets, $12 trillion as a genre. Then you add the sovereign funds and you add the public pension funds. Soon you're talking about real money. You were mentioning earlier social ostracism, which I suppose means that you no longer get a Christmas card from the Governor of the Bank of England.
Professional ostracism, David.
But you could actually use that buying power, that mass of assets, in a very good way as a kind of punishment of those who don't really live up to the standards. And of course you could use that power of asset management in a very socially useful way. And I just wonder whether, not perhaps the Bank of England, but central banks as a whole, shouldn't use that mass. Also, if you throw in the other public groups that one has at one's disposal, it would actually be an extraordinary force for good in all kinds of ways. And I wondered whether that has crossed your mind.
It has not been a conversation that we've had, first point. I would say that, by and large, the central banks, the central bank asset managers, have implemented changes to market practices. They've been at the front end of implementing those changes to market practices. So, for example, two-way margining on derivative contracts, even though many of them are AAA, those have been implemented. Bank of Canada, where I was there, that we did it at the front. So things such as these issues around derivative stays, one would expect that the central banks would. I hesitate to suggest changes to the investment philosophies of broader pools of public pools of capital, but I think you would find in talking to the managers of those pools that they tend to take a longer-term view. They tend to take a view about the system. They tend to think about how the system works, and they independently tend to manage their affairs consistently with that. And one sees that in terms of market share of various private institutions with those pools of capital.
I'm conscious that I'm keeping the Governor and you from your main course, so I'm going to have one or two quick more questions. There was a gentleman there. Yes.
Yeah.
Okay, Tim.
Yeah.
Governor, thank you very much for your introduction. My name's Alan Yarrow. I am chairman of the CISI. We are a accrediting body for people in wealth management. We've recently had the Lambert Review looking at what's happening in banks. He's come forward with a very good suggestion that he's going to rely more on the professional bodies to make sure that their staff are properly qualified.
Yep.
He didn't go so far as to argue that they should remain as members of those professional bodies. Looking at regulation generally, regulation is introduced every day in our business, and keeping up is quite difficult. We already have an infrastructure for professional bodies. Do you endorse the idea that those people involved in finance should be members of professional bodies?
Yeah, well, depends on what you mean by endorse. Should they be members of professional bodies? Yes. Should those professional bodies be effective? Absolutely. Are they all effective? No. And if they're not effective, should they be supplemented? Yes. So how's that for?
That's a pretty clear answer. One last question here, gentleman here.
Thank you, Jesse Norman. Thank you, Governor, for an absolutely fascinating speech. One word you haven't mentioned, which I think everyone would agree is fundamental to inclusive capitalism, is ownership. And I wonder whether you think that, given in many cases the reasons why these institutions failed in the financial sector can be traceable to poor ownership and poor selection of directors, perhaps, whether you think there are things we can do to improve the quality of ownership of financial institutions, or indeed the quality of ownership of companies more widely.
Well, it's good. It's just like being back at the TSE, Jesse. For those of you who don't know, Jesse Norman, one of the leading members of the Treasury Select Committee, who have led many, has led both the TSE and also the Parliamentary Commission on Banking, have led many of the reforms here in the UK. And one example, just to twin that point and your question, goes to the senior persons regime. Which is an initiative that came from Parliament. I referenced it in the speech, and is being implemented now by the PRA, the regulatory arm of the Bank of England. And the reason it goes right to the heart of this, which is that directors didn't fully recognize their obligations, including down to chairman in some of these failed institutions. And we're now in the process of making it absolutely clear their responsibility for all the activities of the institution, all the material activities of the institution, and that it will have consequences. And we're making it clear ex ante, which will have an impact, I think, in both the conduct of the institutions. It'll have an impact in terms of their interaction with their owners, with their shareholders, and ultimately reduce this sense of systemic risk.
I know there are lots more questions, but I think the Governor needs to have his dinner, and so do you. But, Governor, thank you so much. That was extremely bracing, and I think in some ways a call to arms.